Testing, testing, 1, 2, 3. All right. Good morning, good morning, good morning. How you guys doing? Everybody's ready and excited to watch the opening bell. Here we go. We've got about 3 minutes left until the bell rings, and then all the orders from all the overnight session get filled, and that's where the market goes crazy. Oftentimes we get a nice trend, sometimes we don't. Sometimes we get a lot of whipsaw, so it's kind of a gamble to trade that very first morning bell right out of the gate because you don't know what's going to happen. Today I've got a good presentation for you, a little Sunday school lesson we're going to go through. We're going to actually go over and talk a little bit about the stock market. So today is Thursday, and we're going to talk a little bit about the stock market. And so bring your favorite stocks with you. Look up those symbols, and we're going to go and ask you guys which ones you want to take a look at, which ones you want to see. So we'll get ready here for the opening bell. These are the range bar charts once again. Yesterday we introduced you to range bar charts and told you a little bit about what they do. These are range bar 9s. You can change them to any time you want. What is a range bar? Range bar is a bar that has no time involved, so there is no time. It can take 1 minute to create a range bar 9 chart, or it can take 30 minutes to create a range bar 9 chart. It just depends on how far the market moves before it creates a new bar. And in this case, we've got it set to 9. So it has to move 9 minimum moves or 9 ticks to create a new bar, and then it'll create the next new bar. So it's all about trend. It has nothing to do with time. How much time? It's irrelevant. Time is irrelevant when it comes to range bars because the only thing it's looking at is trend. So you can see right here, the NASDAQ, not trending, okay? A little bit of a down trend, but kind of not, not the greatest trend. On the other hand, down here, the Russell made a nice uptrend here, made a little trend here, little trend here, little trend here, little trend here. Looks like it's getting ready to trend back down again. So that's kind of how you read these charts. You just have to take into account what they've done in the past and try and project out into the future. Past performance is not necessarily indicative of future results, but it is the best we've got. So we have to deal with what we got, right? So nobody knows what the markets are going to do. Nobody knows the future. So it's all about probabilities. What we're doing when we're trading is we're just trying to learn the language of the models that are on the screen that we're seeing. We're trying to figure out who it is that's trading at any given time. Is it a big speculator that's pushing the market? Is it a bank? Is it a hedge fund? Is it the computerized systems out there? Lots of Autobots that are trading. And then we have to just, take those signals and those events and try and jump on and see if the market's not going to move and see how far it's going to move. We're going to ride it as far as it'll go. And once it stops going, we get out. That's the name of the game. So then we wait until the pony starts to run once again, and then we get out, take our profits. If we get in and we're going in the wrong direction and it comes back and whacks us, well, we get out quick. The whole name of the game is get out quick when you're wrong. That's the name of the game when it comes to day trading. You know, get out quick when you're wrong because you don't want to have to go and recover all those losses. That takes a lot of work, effort, and energy. So recovering losses is way harder than just making money in the first place. So don't let it take a lot of money away from you because recovering those losses is difficult. So there it goes. There go the ponies. Here we go. Busting out already. The Russell's dropping down like a rock. Here's another quick opportunity on the Russell as it pulls back. Is it going to be rally? Is it going to rally? Is it going to pull back? What's it going to do? That's a little flag formation right there. Is it going to continue to run? Look how fast that NASDAQ goes. These range bar charts sometimes, because they're, no time involved, they can really move. They can really move. Okay, here's another drop on the Russell. If you're anxious to take a short position on the Russell, now would be a good time to do it. We could jump in there. And we're going to put our trailing stop right on that little green dot that's in there and just let that baby run. Try and take the run out of the morning bell. I don't usually do that. I usually sit aside and let these ponies run on their own. Sometimes people ask me, why aren't you trading that morning bell, Land? Get in there, get in there, get in there and fight. Well, it's tough sometimes to take the morning bell. So, you never know if it's going to just trend. Oftentimes it has a beautiful trend, but sometimes it just beats you up real bad. And so not always the best to try and jump in with these guys, but Because oftentimes all that's really happening is the big companies like Citadel, big clearing firms. All they're doing is clearing out all the orders from the overnight session. So people come home from work, they place their orders, they get in there, and then the orders have to be filled. And when do they fill them? No, they just fill them on the opening bell when the market opens. So you're allowed to place your orders in the middle of the night. They just don't fill until the next morning. So they're off at work doing their thing or eating breakfast or, getting the kids ready for school, and their order gets filled on the opening bell. And that's what we're seeing here in the first thing in the morning. We're seeing the opening bell. So let's go ahead and we're going to continue to trail down on that ATR. I brought it to break even. Sometimes it's nice to break even. Sometimes it's nice to trail. You never know, right? You never know. You're just going to do one thing or the other. Sometimes there we got stopped out. See, if I would have let it go, it's still going to go. Is it going to go rally back? What's it going to do? Nobody knows. Nobody knows. It's like a carnival game. You want to try again? You're going to see if it's going to pop back or is it going to continue to fall? Let's see if it's going to continue to fall. We'll put another order in there. We'll risk our $55 that we just made against the next run in the market and see if it wants to continue to fall. Come on over. Throw this ball in the apple barrel. You can do it. You can make it stick. Come on. Throw that ring around the pop bottle. Come on over. Throw that dart at the balloons. Play the carnival game. Market's starting to fall. Here we go. Make it another run lower. See if it wants to continue to trail down. We're still in a losing trade because our stop is further back than our entry. And until that stop moves forward to our entry, we're still in a losing trade, right? If it comes back and hits us, there, just jump to break even. Let's pull this thing up so you can see a little better. I don't usually trade this first opening bell, but a lot of guys put the pressure on me and say, Land, trade. We want to see you trade. So here we go. We're going to come down. We're going to trail one more time on that ATR. All right, here we go. Trading the carnival game. Up a little bit more here. Just broke $150. Let that baby run. Stochastics is way down in the lower region. It's down in the oversold region. We learned about stochastics yesterday. If you don't know how to read the oversold region, the overbought region, go take a look at that video yesterday where we talked about overbought and oversold. So when the market gets down into that region, we kind of expect or anticipate that the market's bottoming out. But sometimes, you never know. It's just a mathematical model. Who knows whether it's right or not? It's right sometimes it's not. Oh, seems to be right this time. Bottomed out down there. The market's starting to come back. What are we going to do? We're on the third drive, aren't we? Drive 1, counter trend. Drive 2, counter trend. Are we going to get a third drive down? That's the question. Matt, are you going to take that third drive down? I'm sure Matt's in the house. He's out here trading the carnival game. Got himself a position. Probably up $1,000, trading 10 contracts. Here we're getting a little bit of a reversal. What's going to happen? Ride the ponies. Let's go take a look and see who's in the house. It's always nice and fun to see you guys come in and say hello. So we got a few guys in here. Matt, there he is. Morning, land and all. Matt's in the house. You trading this, Matt? Did you take a short position on this market as it dropped out with the Russell? Look at the Dow. Holy cow. That's the one we should have been trading. That Dow really had a nice run in there. If we had come in here and dropped an order on the Dow, that was a $415 move. Sweet. What about that S&P still tanking down here after this nice big long rally on the opening on the pre-market session? Pre-market session, and then that thing drop. NASDAQ was going too fast. It was really going crazy. Look at this NASDAQ. One up for every down. Remember, we got one up for every down. We just don't know how big those ups and downs are. Sometimes the ups are big. Sometimes the downs are big. Sometimes the downs are big. Sometimes the ups are big. There they go. Ponies are running. Orders are being filled. Everybody's excited. The S&P is still dropping. We put in our Fibonacci ruler in there from the low to the high. What have we got? We got right back down into the Fibonacci sweet spot. Holy cow. Right there. Getting ready to bounce that 61.8. There it is right there. Here we are coming in with a double bottom. Got a double bottom down here on the Dow. Dow's bottoming out down in here. Let's see if it holds. That might be a turnaround point where the market starts to rally once again. You take your position long and look for that thing to come back up. Where to? 50% or 61.8 if you want to be an engineer here. See if it won't come back up into that Fibonacci sweet spot. Right in here would be your initial target. If that thing breaks those green bars, then we'd look for it to break above the previous high, and then up we'd expect it to go. Of course, it doesn't have to do that. It could turn and continue to fall because it's a drive one, counter trend, right? Drive one, counter trend. And then down it could flush one more time. We get another drive down. So we could get drive one, drive two, drive three. Looks like to me the NASDAQ has filled all its nighttime orders and started to go sideways a little. Getting that little sideways trend in there. See what there's. See where the other traders come in. I got to get my hot tea going already. S&P is bouncing that 61.8. All right, Michael Bruce is in the house. Good to see you, Michael. Great to have you guys here. Good morning to everyone. All right, we got Bruce R. Good morning, everyone. Bruce says, oh, good morning. Michael Bruce says, one question. Where can I find the advanced technical course I purchased with Pit News? You go to tradementors.com, and up in the upper right-hand corner, there's a login button. And when you click that login button, it'll take you to a screen where it'll ask for your username and password that should have got emailed to you. If it didn't, hit the little button that says, I forgot my email and I forgot my password. It'll send it to you again. And if you have any problems, let me know. I did create. I didn't test it, so I'm hoping it's working. But I did create a special email address just for you guys here on YouTube. So I know it's coming from you guys because I'm not going to tell it to anybody else except for the people on YouTube. And it's called asklan@tradementors.com. Asklan, ASKLAN @tradementors.com. Write that down. If you have any questions, you can send it right to me. Now, you're going to have to put something big and bold and loud in the subject field, like YouTube class, all cap letters, because I get a lot of spam that comes to that email folder. And so if you don't really make it big and bold, I might not see it. Okay. So asklan@tradementors.com. So Michael Bruce, go see if you can log into your course. If you can't, let me know. And when you buy that course, that gives you some time with me so you can sign up, and we'll do some one-on-one, help you get your software up and running, help you work with you a little bit to help you talk about your goals and aspirations when it comes to trading. We got G Wiz in the house. Good morning, my friend. We've got Selena Pavlov. Good morning, Selena Pavlov. It's great to have you in class. We got Matt Baker is short the Russell. Are you still short, Matt? Are you taking that third drive down? We got Quinn Ranson. Morning, rough day yesterday. You had a rough day, Quinn? What happened? You have a rough day? Let us know. B. Taylor, good morning, everybody. Glad to have you. We've got Boris Jantz, greetings. We've got G Wiz says, Land, do I access the spreadsheet? I have Pit News, thanks. Do I access the spreadsheet? I have Pit News. Yes, you should be able to get the spreadsheet. Once again, I don't know for sure. I don't know how to access you. I don't know your contact information. So you're going to have to contact me. And just send an email to asklan@tradementors.com, and I'll send you the link to that spreadsheet. It was in the landing page, and it should have sent you an email that had it in there as well. So, but if you still can't find it, let me know. Asklan@tradementors.com, and I will send you the link. Kirk's in the house. Good morning, folks. Matt says, the advanced technical course is great stuff. Glad you're enjoying it, Matt. Good deal. And yep, still short, added on to the short. Nice, sweet, way to go. Holding on for the long haul. I always say the big money's in the long trends, in the long positions, staying in there for the long run. That's where the big money is. A lot of guys like to scalp. Scalping's okay, nothing wrong with scalping. We like to scalp once in a while, but usually the only reason we scalp is because we're not confident the market's going to take a long run. So we'll scalp it out. But if you feel like the market's got a good trend in it, stay in, because that's where the big money is. That's why we do a strategy called scalp and trail, right? Scalp and trail. And we've talked about scalp and trail. It's where you get in with a couple of contracts. You take one off quick to cover your expenses and let the other one run. See how far it'll go. Don't get anxious to yank the money out. And then you can start doing some, if you get in with multiple contracts, we'll get a little bit more sophisticated when you start trading bigger position sizes, but you can start pillaring and pyramiding your positions up once you get into one of those nice big trends. And that's the way you do that. Pillar and pyramid. Build your position as it moves through price and time. All right. So we got a little bit of money out of there. $100. That's not bad for a little morning throwing darts at the balloons. Not bad at all. All right. So what do we got going here? Let's keep watching. I want to go over and look at some different markets. We got the NASDAQ starting to rebound off of that move lower. Now, again, remember, these are range bar charts, so they're moving really fast. If you want to back that off a little bit, you can go back down to the 1 minute charts. In fact, I'll show you. We'll go look at some 1 minute charts over here. A little bit more familiar with what you're used to seeing. So there's the 1 minute charts. I got those decorated up here with the advantage lines. And advantage lines are a really good little tool. I just need to have some trailing capabilities added to those. I've been working with the programmers, see if we can't figure out a way to put some trailing capabilities. We can trail behind price bars back, we can trail ticks back, we can trail all kinds of fun things, but I like those. I like things like ATR with those dots. Those are beautiful things. And let's see, overlay, ATR, advantage lines. We don't need to have these lines in here. But see, we're not, we're using on this particular chart, we're using that might be a little tight. Oh, well, the market's running. We'll go, and I'm going to apply that to all charts just like that. Now all the charts look the same. And you can see this is the 1 minute view, okay? So if that range bar chart gets you down and you're like, oh, that thing's moving too fast and it's got too much going on in there, this is the 1 minute chart back to kind of the normal view of what we're used to seeing, right? This is how we've been doing it over for a while, but we got that new feature in there where we get to see the Hienashi bars on the range bar charts, and I wanted to show those to you, and they're kind of fun to play with. They're a little bit more aggressive. But this is what the market looked like on the Russell coming out of this thing, out of the morning bell. So that was at 7:20. Now remember, the bell opens at 7:30, so they start filling orders right there. So that big drop right there was a flush. So Matt, I'm going to ask you, do you trade prior to the opening bell? Do you try and get in up here and ride this market down? Or do you wait for the bell to occur? Just curious how you like to read that morning market. If you want to share. We got that nice big long downtrend on the 1 minute chart here. We slowed it way down with this 1 minute chart, didn't we? Slows way down, but those bars are a lot bigger. Take into consideration that this one run from the opening bell down here, that was a $390 move on that Russell down there. Let's go see if we can look at, range bar indexes. Let's see, do we have just the Russell? Mini Russell, micro Russell. I don't have many. I'm sure I got mini Russell in here. Mini Dow and Russell. Let's go look at the mini Dow and the mini Russell. I got those already in here. Mini Dow and Russell. Okay, so we got the 1 minute chart and the 2 minute chart. So the 2 minute chart is my long-term chart over here. On the 2 minute chart is the long-term chart when you're trading. All right, when you're day trading. So this is on the bottom side, we got the Russell. So the Russell's making a retracement on the 1 minute chart. The Dow is still dropping. It's coming out the bottom. So that's why I like to look at all the markets together. So combined, these are usually the two markets I like to trade myself the most, the Dow and the Russell. Actually, I like to trade the NASDAQ too. I like to trade the S&P too. That's why we look at those four markets. I just like all four of them. But the this is what we're seeing right now on the Dow. This is the 2-minute chart. Let's change this over a little bit. All right, let's come in here, and just for fun, we're going to make that, I'm going to come down here. I'll show you how to change the time frames. If you right click over here, like I'm right clicking on the chart over here, and I'm like, okay, we got range 50 set in here. We got 1 minute, 2 minute, 5, 15, 60, daily, weekly, monthly, and then we don't have the range 9, which is what I want. So I have to put it in there. So we're going to bring this chart full screen, because you got to go full screen to get the little tabs down here, the time tabs down here in the bottom left corner. So I'm going to right click on that. It's going to pull up this screen, which I hate because it pops in front of the chart. But you got to do it. Got to do what you got to do. And we're going to come in here and we're going to put in 9. And I'm going to make that last one instead of a 60-minute chart, because I don't use that very often. We're going to come down here to range bars. You also have bid ask bars and volume bars, but we're working with range bars. We're going to go to 9 right there. We're going to apply. So when I apply that, that applies that to the software. Now that last tab down there is a range bar 9 tab. I also have a range bar 50 up here, which we could use as well. But I just use that, just turn that tab into a 9. So those tabs at the bottom are customizable, user definable. So now we're going to come in here. Look at that Dow drop. Holy cow. Dow's on the move. So now we're going to come back over here. And now when we right click on that, we got that range 9 in there, and we can put that onto range 9. We can drop this one to range 9. Now we can bring all 4 back up, and now we can see range 9. Oh, and look, we got Hienashi on the right side on the 1-minute charts, but Hienashi is not on the left side because we got these new charts that we're setting up, and we also got, that's not a candlestick. So let's come in here and we'll make this one candlesticks, chart type candles, and we're going to make a Hienashi. So click Hienashi. There's Hienashi on the range bar 9. There we go. That's how you do it. Okay, and we're going to bring that back up. And that's still got the bulls and bears on it, which is fine. We'll leave that on there for now. And then we're going to come in here and we're going to do the same thing over here. This is a range NAR. It's already a range. It's already got the bulls and bears. It's already got the these are the typical normal range bar 9s. Every single one is 9, right? So that's a range bar 9. Now we're going to turn Hienashi on. This is the magic. Okay, boom, Hienashi. I think that helps, don't you? Gives us a little bit better view of the market. Kind of puts a little smoothing factor in there. So now we can see the range bar on the left side, and the Russell on the Russell here, and the 1 minute on the right side. That makes the 1-minute chart, if you look at it like that, that makes the 1-minute chart the long-term chart. So we're going to change positions, put the 1-minute chart over here on the left-hand side, and we're going to put the range bar chart over here on the right-hand side because it's the shorter time frame. And now you can see the longer-term trend, which is the 1-minute chart. You can see the range bar 9, which kind of breaks that down. So that over here on the left-hand side, we got 1, 2, 3, 4, 5 bars. 5 green bars. Beautiful, beautiful 5 green bar run. But look at what it was over here in the range bar 9. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. 22 big, long green bars. So it broke it down 5, 10, 15, 20 by 4 times in this case. Now, 1 minute versus range bars. Now, again, remember, range bars have no time. So it could have just been, depending on how fast and hard the market's moving, you get a bar, a green bar, for every time the market moves 9 ticks, not a time frame. So now the market's coming in here, starting to flag a little bit. We're getting a little flat bottom in here. Could be a continuation of the downtrend. So we come in, so we go X, 1, 2, and then down this thing comes, and we could look for a continuation of that downtrend, right? This is just a 1-minute chart after all, and we could get this continuation. We shrink that down to where we can see where this thing's going. It could flag here and continue down. So if you want to take another short position, we'd anticipate a continuation of the downtrend. But over here, we're looking at it, and we get just a little bit more granular view. So we get that, that's that run coming down, land saying it flagged right in here, right there. It's getting ready to fall. You want to take a little bit smaller risk, you can do it over here. And then if it bounces back, but you know, over here, you're taking a little bit bigger risk on your stop. So you're putting your stop 1 price bar back behind here or up here at the yellow dots. Well, the yellow dots and the blue dots are a little bit different distance. So now it's coming in, it's breaking that high right there. It's not breaking low on the 1 minute chart. It's pulling back against us. You can see that pullback over here in the Russell. So now we have to kind of take that into consideration. You got a kind of a more granular view using that range bar 9. And I don't know if you're going to like that, whether that's going to be helpful for you or not. So it's just another tool in your quiver. So maybe something you guys will like, and that's why I want to show it to you and teach it to you, because it's a neat little tool. You just might like it. Let's see. I still got Matt up here, and you guys probably can't see a damn thing I'm showing you because I forget to turn the notifications off. Michael says he got it. Good. Glad you got in there. Matt says he waits for the bell. He doesn't jump in on the pre-market session. Pre-market session in the stock market. The pre-market session in the stock market, you can only take limit orders. But the pre-market session in the futures market, you can trade it just like you would any other time of the day. We don't care. We don't have those silly rules that the stock market has over here in the futures market. You can go and trade the trends. And you don't have to be worried about whether, I can only do a limit order. Oh, I can only do is this time of day I can only do this, or is this time of day I can only do that. We don't change the rules like that for you in the futures market. So you have the same rules. You can do stop orders, limit orders, market orders any time of day. We don't care. Can't do that in the stock market. If you try to trade prior to the opening bell, you have to use a limit order, and you've only got that little tiny window, an hour, hour and a half, 2 hours before the market opens, right? So most of those orders being filled are just nighttime orders. Again, that's why the market goes crazy in the morning, is because they're just filling all the nighttime orders that they wait to fill. Because even if you place an order in the stock market at 12 o'clock midnight, and then the market opens with the pre-market session, which is 2 hours before the opening bell, all these silly rules. So stock market, they still won't fill your order that you placed at 12 o'clock until the opening bell, which is 9:30 Eastern, even though they opened the market 2 hours prior to that in the pre-market session. It's a carnival game. You got to have rules, or else it's not a game. It's no fun. Change the rules. Yeah, right. No. Got to have rules. Got to have rules. If you don't have rules, how can you have a game, right? We don't have all those crazy rules over here in the futures market. We just like, why do you do all that stuff? It just confuses people, makes it hard to trade. Just open the markets up and trade them. Just let people trade. Just let people do what they want. No, we're the stock market. We got to do things hard, make it difficult. That's why we're over here in the futures market. All right, go play your game. We don't care. We're going to play our game over here. I have different rules. All right, guys. Sorry about that. I was sitting here talking about this Russell and the thing, and I left my little marker up there on the screen. Michael Bruce says he's going to get in and try and learn how to use the software after class. I'm here to help you, Michael Bruce. I'll help you get up and running with this software. If you need my help, I've got that. When you get into that class, you got access to my calendar. And you can put yourself on my calendar. We'll get together, and I'll help you get your software going and work with you one-on-one. Ha is not an option in the demo account, right? HA is not an option in the Hienashi is not an option in the demo account. No, it is. It's there. In the demo account, Hienashi is there. Now, there was a time where you could only get Hienashi on range bar charts in the live, but not in the demo. But it's now available in the demo, so you can go get that, Selena. You can have Hienashi in the demo account now. So the getting to the Hienashi bars in track and trade is a little bit difficult because I don't know. Programmers didn't realize they think it's this. It's just a modified candlestick chart, right? So if you right click in track and trade, it gives you the price bar type right here. And then you have open, high, low, close, close, open, and candles. Well, Hienashi is a candle, right? I mean, it's just a different kind of candle. So they didn't put Hienashi inside of this list for some reason. So what they did is they said, well, you got to come down and you got to go to the chart preferences tab, which is just right here. You right click on the chart You come down to chart preferences, you click on that, and that gives you this scary window over here. But this is how you set up your chart, and all the different color codes, all the things you want, the bar colors, all that kind of stuff is over here. And in this window, you have to search and hunt and find, but it's right here at the top. When you have candlesticks, so you're on the range bar 9 because that's your chart that's selected. That's right here, candle range bar 9. You select Hienashi right there. And so that will turn it on and off. That's how you turn Hienashi candlesticks on, is inside the candlestick setup in the chart preferences. Now, we do have a shortcut to that, okay? And it's up here. You see my little HA is on the bar up here. So up here on the bar, I have HA, but they don't put that up there when it comes out of the box. That's why I always tell people, the charts don't come out of the box the way I like them. I have to modify them and change them, make them the way I like them. You know, and then you don't just open up Track and Trade and suddenly it's, oh, it's right the way Land sets his up. No, you have to kind of get what they give you out of the box and then go set all this stuff up. So that's where I'll help you. I'll help you with that. If you sign up for Pit News Magazine and you click that little button that says, yeah, I'd like to have the course material too, then that gets you some one-on-ones with me where I'll come and help you one-on-one. I'll help you set your charts up. We'll get together. We'll do that Zoom meeting thing and I can see your screen and then I can help you set all this up. But I'll show you in here too. You just ask your questions. I'll tell you any answers you want in here. That's why I'm here. So I'm going to show you how to set that HA up on your bar. So in Microsoft, just kind of standard Microsoft way of doing things, you see a little handle up here on these bars. So your little bars have a handle on them, and you can grab that little handle and undock them and move these around. And sometimes they let you dock them on different parts of the software. I don't think we can dock them. Yeah, we can dock it. Look at that. We can even dock our, if you want your tools going down the right-hand side, you can dock your tools on the right-hand side. See that? So you can put your tools, or if you like your tools over here on this side, I think you can put them over here too. Yeah, look at that. So you can do all kinds of fun stuff and design your software the way you like it if you like your tools over there. So, but you can undock them, but you can also modify them. So that little handle, all you do is you right-click on it, and it says Customize Toolbar. So you come in here, and then it gives you this little box. And then you have all the tools that are available over here in the left-hand side, and then you have all the tools that are on your little bar right there. So what I do is I come in here, I find the Hienashi bar on the left-hand side, and I move it over. It says add it to the right-hand side. And then you can move it up and down in the bar depending on where you want it along the list. And so in here you can see I have my Hienashi added in to that, and that's why I have that HA up there. And that's how you do that. So we'll come in here, we'll redock this up there where it belongs, and we're back to normal. And now I can show you something that's funny about the way they do this. If you hit HA right now, it affects all the open charts. So I've just turned off Hienashi for all the charts just by clicking that little button. So Hienashi is now off. So this is what you look like. This is what most people would look like if they were looking at a regular chart. And these are 1 minute charts. Remember, over here on the left-hand side, that's what a chart looks like without Hienashi on it. Hard to trade, in my opinion. It's really kind of choppy and hard to tell. You can't really tell what the trends are. That's why I like Hienashi. So this is what the charts look like without Hienashi. This is a range bar 9 without Hienashi. Now we're going to hit Hienashi again. Boom, turn it on, and there you go. Now you got Hienashi on. Now what if you wanted Hienashi on all the charts, but not on the, let's say, the range bar 9s? Well, if you want to turn off the range bar 9s, you have to bring it full screen because it's going to affect everything that's open. So if you bring this full screen, turn off Hienashi, now I go back to the minus screen, these three still have Hienashi, that one does not. Oh, I don't want Hienashi on the Russell, on the 9, so come up here, turn it off, go back to the 3. Now your range bar 9s don't have Hienashi, but your 1 minute charts do. Now, if I click Hienashi when all 4 are up, it's going to toggle them back and forth. So now the 1 minute chart does not have Hienashi, whereas the 9 range bar 9s do, because we've set them like that. So yeah, it gives you the power to turn things on and off in different modes if that's what you want. So, gives you all kinds of options. So now we can toggle it. Now our 1 minute charts have Hienashi and our range bar charts don't. Click it again. Range bar charts have Hienashi, 1 minutes don't. Oh, now we want it to be so they all have Hienashi. Well, I have to bring them up one at a time. So bring up the 1 minute chart, turn on Hienashi, come back down, bring up the other chart, turn it on. Now I got Hienashi turned on. There we go. Now we've got all 4 charts having Hienashi, and that thing will flip it back and forth. So that's how you put Hienashi on all charts, and that's how you get it turned on, and that's how you get the little toggle switch. So that's the way it's done in track and trade. So let's see. Sorry about that, Michael Bruce. I left Matt on there, and we were sitting there talking about the charts. I need to stay a little bit more coordinated. I tell you, I'm still kind of new at this YouTube live stuff and trying to project at the same time, that because I see everything. The projector is over on this screen. This chart is over on this screen. And so I'm focused on the chart and what I'm doing over here, not realizing that I've done something stupid over there. So I apologize. I wish there was sound so you guys could say, "Hey, lad, hey, get my attention." But you can't do that. So John Mackey says, "Morning." Got still some people in here, and then you're welcome, Selena. Hope that helps. All right, let's get back to what we were talking about here. What are these markets doing? This is the 1 minute on the left-hand side, Dow on the left and right-hand side. This market's coming through some nice wave patterns. So we got downtrend, uptrend, downtrend. Remember, there's one up for every down. And these bulls and bears is this blue light system in here with the color coding. Color coding is what's turning the price bars red, yellow, and green here on this range bar 9 on the bulls and bears. And that's all based on Fibonacci and Elliott wave, right? So these blue lines, these blue dots in here are counting the Elliott waves. So we got drive 1 up here, you can see, and then drive 2, then drive 3, and we got a reset. Now we're coming in, looks like we're going to go with another ABC bottom formation in here. The question is this thing going to come down? And we got a low point right here. We're going to watch for it to see if it's going to test it. Come down and test that. Technically speaking, what we want to see, right? Technically speaking, A, B, C. So we got this ABC pattern. We'd like to see it come down and create a full, what we call a bow tie, right? A bow tie is when the market pushes all the way past this break right here and comes down and tests this 100, 130, 161.8% level on the Fibonacci ruler. In reality, what we'd like to see all the way down to 200. That would be nice, right? A nice, big, long drop. Doesn't usually happen, pretty rare, but that's what this is all about. The probability scale, all the way down the probabilities. So the further down the scale it gets, the less probable it's going to become that it continues to go. It likes to bounce off of these different mathematical models as it comes down through these price and time. But the idea is if the market comes up and creates a bow tie, which would be start here, up to here, down to here, back up, uses the previous level of support as resistance, and we tie that bow tie off. And so that gives you this pattern that is an Elliott wave pattern. Now, does it happen like that all the time? No. But it happens often enough that it's where we can place our money, right? We can bet on it. I hate to call it betting. Invest on it. I've been trained by the government. The government does not want us to call this betting. They don't like us to call it betting. They tell you, don't call it betting. This is not betting. This is investing. There's a difference. Okay? There's a difference. So as this thing comes down here, our strategies are to watch these markets make one up for every down. If the market's not making one up for every down, if it's going crooked all over the place, it's still going to be one up for every down. They're just going to be really tiny. So you have to be careful. You want to make sure the market's moving in nice, big enough one-ups and one-downs that you can take advantage of them. But it's those natural crossovers. And how far the market's going to go on those one-ups and one-downs is the real question, right? Now, the 1 minute chart over here, you got your one up, you got your one down, you got your one up, you got your one down. Markets just move in waves. That's what we call Elliott waves, right? One up for every down. Sometimes they're small. Sometimes you have little ups and downs inside of bigger ups and downs. So we have a little up and down. This is a little up and down, up, down, up, down, up, down. Usually we'll get 3 of those. And that one we did. 1, 2, 3. 3 little drives inside of one bigger drive. It's called a fractal Elliott wave. Okay. So we have fractal drives. So one up for every down. And the way you judge that is higher highs and higher lows, lower highs and lower lows. Once the market's making higher highs, right? Let's bring this up so you can see it a little bit bigger. Making higher highs, that's when it's in the uptrend. When it stops making higher highs and starts to fall back down, That's the one down. And then it starts going back up, higher highs, higher highs, higher highs. As soon as it starts making lower highs, it's not in the uptrend anymore. See that? How it comes down, breaks down, makes a lower high. Then starts to rally once again, higher highs. And usually, like I said, you'll get one longer drive, which is what the blue light's indicating. And inside of that longer drive, you get 3 smaller drives. Okay. And then once it gets up to the top of the third drive, statistically speaking, doesn't mean it can't go 4, 5, 6, 7, 8, 9, 10. Certainly can. But statistically speaking, we'll generally get 3 of those, and then we'll get a drop, right? We'll get the other retracement. And now we're getting the longer term wave down. So we get down, up, down. And then once it comes down here, how far is it going to go down? Well, you got some tools to help you say, well, it's getting down there. And one of those is the stochastics, which we talked about yesterday. It's coming way down into the oversold region. And so this is a spot where we're going to look for this market to come down. Fibonacci projection, A, B, C, down it's coming. 130.9 is the Fibonacci golden ratio to the downside, right? So that's kind of our ultimate goal right there. Now, is it going to come down to exactly that number every time? No, of course not. But that's just kind of the Fibonacci mathematical golden ratio. So we like to see a market A, B, C, D down to 130.9. 160.9 is good too. Go ahead. Come on down. Come on down to that 160.9. We like to see that because the rebound, if it comes down there and breaks that one, then the next one would be 200, right? We have to also take into consideration these even numbers. Now, I'm not sure I got those in there very well. We're going to come into the chart preferences, make sure our even numbers. I like to go about 25s or 20s or 10s, even numbers, because markets like to bounce between these even numbers. So it depends on how tight you want to go on these. But usually we're going to go 50s. 25s are good, so halfway in between the 50s. So there you go. So that gives you these numbers along here, and it gives you these horizontal lines. You'll notice markets like to bounce between those horizontal, those even and odd, even numbers. Not so much. I'll see it came right down to 34.075 and bounced right there, right off that even number. So be mindful of that. These even numbers are important to them. There's also another thing. We haven't got into this yet, but I'm going to show you since we're talking about areas of support and resistance. Look at that beautiful trend. That Dow just, wow, that's beautiful. Now that's on the range bar 9. So if we go and look at that, compare it to the 1 minute chart, this is what the 1 minute chart looks like. Nice, beautiful drop out of that market. Okay, how big is that drop? $1,000 investment from here to here. That was $365 for every $1,000 you put into the market. That's a beautiful move. This market's really been making some nice moves in here today. So we come back here, and the thing I wanted to show you, now I can't show you on, well, I can't show you on the Dow and the Russell. So we have to do that. Talk about that when we're going to start talking about options. We're going to start trading options next week because I start my options class at the university. And so options, getting excited about options. So we're going to start trading options next week. We're going to do some options trading. Put on some iron condors, go along with some options, some call options, some put options. So we're going to add another layer of probabilities, of opportunities of taking advantage of these markets to our trading. So we started out just kind of randomly coming in as, rogue cowboys. Oh, we're going to buy whenever we want to buy. We're going to sell whenever we want to sell. And we're going to just try and make money. And then we started getting a little bit more sophisticated. We started adding trend lines, and we started talking about color codes and different ways that different price bars look. And then we started adding some technical analysis. We started reading charts. We started going through the process of analysis and technical analysis and higher highs and higher lows and Elliott waves and Fibonacci. And we just keep adding on to our knowledge base as we've been going through these course materials. Now, for those of you who don't know, I'm a teacher at the university. So I teach at the university, and the reason I have these courses, these classes, is so that I can have my university students come after I teach them how to trade, come and we look at the markets live, because I teach night classes. I teach at the continuing education division. And so my classes are all scheduled at night. The markets, aren't as exciting and fun to trade at night. Now the futures market is open and we can trade at night, but we like to do this morning trading in the morning bell because this is when we actually do our real trading. Don't trade so much at night. Not that you can't, you certainly can, but this is kind of the fun time to trade. So I like to have these labs. This is the lab for my university class. So a lot of the guys in the class are university students, and we're here learning about how to trade. So we've been going through the semester, and as we go through the semester, we've been adding on additional knowledge to our knowledge base. And you guys here on YouTube are welcome, welcome, welcome. We love to have as many people who want to come and join us in our university lab class as would like to, and we're going to continue to do that. And we start on Monday with options. So we're going to start trading options on Monday. Can you day trade options? Yes, you certainly can. And in the futures market, we can day trade options. And so we're going to start getting into options. And one of the things I wanted to show you there when I said, well, I can't show you on the Dow, I can't show you on the Russell, is that markets like to move through strike prices, option strike prices, as what we'd call pivot points. All right. So markets like to come down and they like to bounce off of these strong areas of even and odd numbers, even numbers. Right. So we're very conscious of where these are, where these even numbers come in, so that when markets come down, we're going to look and it's going to have to break past that. If they can't break past it, we're going to anticipate a rebound or a bounce off those numbers. Well, they do the same thing on option strike prices. So an option strike price becomes a very important area for support and resistance. And the reason that is because the big boys are generally the ones who are taking the other side of the options trade. So we as small speculators or as retail traders, we generally buy options. So we're buying them, right? We buy a call or we buy a put. And then it's those guys who are selling them to us. They're selling us the options that we're buying. Well, they're big. They can manipulate the markets to some degree, and they can push markets up and down. And if it's beneficial for them, if they sold a whole bunch of options at one strike price, and then the market starts to go the wrong way and they lose money, they've got big, deep pockets where they can kind of push it around a little bit and see if they can't get that market to go back up, so they don't have to pay out on their options. It's kind of a dirty trick. Oh, and you thought that the market wasn't full of dirty tricks. It's full of dirty tricks like that. Clear, full of dirty tricks. I could tell you dirty tricks all day long. Dirty trick stories all day long. All right, so we're just looking at the Dow and the Russell at this point. We don't have the other four up here because on the left-hand side, we're looking at the 1 minute chart and on the Dow and the Russell. Russell's on the bottom, Dow's on top. And then on the right-hand side, this is that Hienashi bars that are on the range bar 9s. So that's what we got going. So Ram Ravi says, good morning. How do we get a demo account to follow along? That's a good question. Go over to this website right here. It's Track and Trade. Track and Trade is the software I'm using. And you can go over there. This doesn't have this little icon here, doesn't have the picture of that's probably not the best one to show you because it doesn't have I'm trying to find the link to the software. Links to the software. Maybe I didn't put it up here today. It's over at trackandtrade.com. Add to stage. So go to trackandtrade.com, TRACK, the letter N, trade.com, and you can download. This is the futures version that we're looking at right now. I actually have the stocks version up, and it's right here. So we have both. Here's the stocks version. So here's the stocks version, and then here's the futures version. So they look exactly the same, but they hook up to different exchanges, right? So when we're trading the futures market, you need a software program that connects to the Chicago exchanges. And if you're trading the stock market, you need a software package that connects to the New York exchanges. two different worlds, two different competitors. I mean, those guys are competitors, right? The Chicago's not really. I mean, they really work in hand because this is the futures market is a hedging market, and we hedge the stock market. But nonetheless, they're kind of competitors. They're corporations. They're not government agencies. I mean, brokerage firms and these big Wall Street is not owned by the government. They're regulated by the government, but they're not. Exchanges are not government entities. They're private corporations. In many cases, you can go and trade their stock. So these stock exchanges are corporations, and they're competitors. They want you to come and trade with them. That's how they make money, right? So they have different rules and different strategies that you work on over in the futures market for one purpose, and then on the stock market for a different purpose. And so they kind of complement each other, but they're also competitors. So the software, when you get it, it's going to look almost exactly the same for the futures market as for the stock market in the tools and all the layout and the functionality. But there's enough differences in the futures market that you don't want to have a stock platform that just trades futures. Oh, come and get my stock platform, and yeah, you can trade futures on it too. Yeah, come and do that. Nobody wants that. I don't want to put my peanut butter in my chocolate, and you don't want to mix those two. You want to have, that might not be a good analogy because peanut butter and chocolate together is pretty darn good. I don't want to eat my cake and ice cream with my steak. No, that's pretty good too. I like steak and ice cream. I don't know. You guys come up with the analogy. You want a piece of software that's designed for the futures market if you're going to trade the futures market. That's the point I'm trying to make. You don't want some half-assed program that was designed for stocks and then they cobble on some big chunk of clay and stick it on to your stocks version. That's not good, because you want a piece of software that's designed for the market you're trading. Unless you don't care. I mean, if you don't care, who cares, right? If you don't care, who cares? If you want to just have some cobbled together piece of software that does it all, some Walmart software, go ahead. If you don't care, I don't care. But I care. For me, I care. I want to have a piece of software that's designed specifically for the futures market. That's all it does. It trades futures. I know it's designed for the futures market. It's got the futures capabilities and the tools for the futures market. Now, is there a lot of crossover because we're still doing trading? Fibonacci Elliott wave works on the same boat? Yeah, sure, of course. But that's how that works. So that's where you get your software. Of course, this is just for the stocks version, but they have a futures version. We have a futures version over there. It's trackandtrade.com. Go get that. You can come and follow along. Follow along with me. Gee whiz says, trade mentorship is priceless. Thanks so much, Land, for all you do. Well, good. I'm glad you're enjoying it. I love doing it. I don't know. I think people have different weird genes. When I was in college, I even wanted to be a school teacher. I thought I always love to teach. I like to teach people. What do I teach? I don't have anything to teach. I don't know anything. And then this kind of world come along of the finance world, and I went through college and went back and started working for the government. Well, not the government, but government contractor, and kind of got involved in the finance world, ended up in the accounting department, kind of blew around a little bit, kind of landed on my feet in the finance world, the world of finance, and started going to the Chicago Board of Trade and Mercantile Exchange. That's where I got kind of my formal education in trading. And so I was there from 2000 to 2010, and that's where I learned how to trade. And I love to trade, and I love to teach people, and I kind of just put those two together, and it's been good. I've enjoyed it. And then I started teaching at the universities. I've taught for 15, 16, 12, 13, 14, 15, 16, 17, 18, 19, over 20 years, almost 20 years at the university level, teaching trading. That's what I teach at the University of Finance. So kind of cool. And then, so I got this great class at the university. I'm at Utah Tech University down here in Southern Utah. And so I'm here teaching classes online. Everybody's welcome. I love to teach, and I love to teach what I know, and I love to trade. It's so much fun. Markets have slowed way down, haven't they? Oh, that's because we're looking at the stock market. This is the stock market, and these are the daily charts. I'm sitting here going, wow, they're sure moving slow. I'm a talker. Chit-chat so much I lose my focus on what we're doing sometimes. So hopefully you guys enjoy it and are learning something. I mean, that's the whole reason I'm doing it. So hopefully you guys can pick up on this and make it part of your life. Because when you get into the world of finance, I mean, it's basically something you should be doing. Everybody knows you got to do something to save money and prepare for your retirement. And, that's what it's all about, trying to give yourself a little bit better life. This is not a flash in the pan, get rich quick program. This is something you're going to do for the rest of your life. So take it slow. I mean, I know we're in a hurry to make money, and I know we're in a hurry to get out there and start building our nest egg for retirement. But we also don't want to lose all our money in the process of trying to make money. And that's the process of trading. You have to kind of be careful, learn, go slow, get demo accounts, practice. And then when you do start trading, you don't have to take big risks. I know you go out there and you watch all these guys on YouTube and it's like, I made $42,000 in 2 minutes. Okay, what did you have to risk to do that? $42,000? No, of course not. Because you're going to get out if you lose 10 grand trying to make 42,000. But are you prepared to lose 10 grand in the process of trying to make 42,000? You have to take big rewards, require big risks. So we all have comfort levels. How much am I willing to lose or risk for the probability that this market might go in my favor and make me some money? And the more experience you get, the more you're willing to risk. The bigger your account, the more you're willing to risk. But if you're going to just start out at this, you got to start out small and slow. I keep making the reference to the fact that, these guys that are doing that kind of thing have been doing this for a long time, probably. And if they're actually doing it, or if it's not just a one-off thing where they accidentally made a lot of money once, and then they got run out there and start telling the whole world about it, which you have to be careful. There's a lot of that going on. But, these guys are probably taking big risks. They're probably putting up $100,000 or putting up $50,000, $60,000 and putting that on the line. And if $50,000, $60,000 goes against you, you can lose a lot of money really fast. Of course, you can make a lot of money really fast. So it goes both ways. So when you get to that level, hey, good for you. Michael Jordan. You're a Michael Jordan now. You go play in the NBA. But for most of us, we're happy just playing college ball. And that's okay. There's nothing wrong. You don't have to be Michael Jordan to participate in these markets. If you want to go out and shoot some hoops every now and again and not even play in a full game, just go shoot some hoops, make a few baskets. That's okay. There's nothing wrong with, what are we up today? $105. Nothing wrong with being up $105. Am I going to go out on YouTube and brag? Oh, I made $105 today. Not going to get anybody's attention. They're not going to think that I'm the superhero of all time, right? They're not, oh, I only want to talk to that guy that over there. He trades 15 contracts every time he goes in. Just drops 15 right on the table every single time. Okay, do that. I'm not saying what you should do. I'm telling you what I do. And I'm very cautious, very careful. I like to watch the markets. I like to teach. Been doing this a very, very, very long time. 30 years of doing this kind of stuff. Of course, not day trading, because day trading, believe it or not, it's not been around for 30 years. When I first started, we got paper charts in the mail. They'd come to you in the mail. And you would, flip through them. And you would say, oh, I think I want to get into corn. I want to get into wheat. I want to get into soybeans. You'd call the guy on the phone. And that's when phones had cords on them, right? Call the guy on the phone and he'd say, hold on, I'll get you into that corn contract you want, Lan. Okay. And I'd hold on the phone and he'd get another phone on the other ear and he'd have me on one side and him on the other. And he'd call the exchange. He'd actually call the exchange down to the floor, actually his broker on the floor, right? And the broker would say, oh, Lan Turner wants one contract of corn. Okay, I'll go get it. And he'd run down to the floor and they'd do that little shake their hands in the air. Lan Turner wants one contract of corn. Okay, I got the price for Lan Turner. And he'd run back over and get on the phone. That guy say, what did he get filled at? Oh, he got filled at $3 a bushel. Okay, Lan, you just got your corn. You're in at $3 a bushel. I pull up my chart and look at it, $3 a bushel. Okay, I'm going to anticipate this thing going to $3.50 a bushel. When it hits $3.50 a bushel, I'm going to call that guy back on the phone and tell him to get out of my contract. That's how we did it. That was day trading. No, it wasn't day trading because, we didn't have daily charts. We didn't know. So then I'd get my charts the next day. Oh, okay. Corn. Corn went down. Should I hang on to it? Oh, I'm down 50, 75. I'm down $100. Yeah, I'll hang on to it. Let's see what it does. The next day I'd get my charts. I'd read them. Call the guy on the phone. Get me out. Get me out. He'd say, hold on a second. I'll get you out. He'd call his broker on the phone. The guy would run down to the pits. Sell, sell, sell. Land wants out. Land wants out. He'd get me out. Come back. Land's out. Okay. Thanks. This is the price. What price? $2 a bushel. What the hell? You're out at $2 a bushel, land. Oh, damn it. That's how it worked. That's how I started trading. And then we got these silly things called computers, and we could look at the screens. And then I really got excited. And that's where I started my company. And we started writing software because I couldn't find any software I liked. And that's how I ended up at the Chicago Board of Trade. That's how I ended up there. Gee whiz. That's a kind word over there. Gee whiz. He says, this is priceless. Thank you very much. I'm glad. Glad you think so. Hope you're enjoying it. Hope you're learning something here. I'm excited. Tomorrow's Friday. So tomorrow's Friday. This market's just kind of being crazy, a little bit sideways right in here. So the Russell's fallen. It started to fall. One up for every down. So we got our down, got our up, we got our down, we got our up, and now we're coming to the big down. There we go. Let's go back. I said I was going to talk about the stock market today. So let's jump over to the stock market. This is the stock market. This is the DIA. So this is the ETF, exchange traded fund of the Dow. This is the spider. DI. Oh, this is the Dow. This one over here is the SPY. This is the S&P 500. This is the Russell here in the stock market. These are the daily charts. And then this is the QQQ, or the NASDAQ down here in the bottom right. And you can see it took off nice and big down here. Again, we're going to come in here and I'm going to show you one up for every down, right? When you're trading, always look for one up for every down. Sometimes they're small. You get your up, you get your down, you get your up, you get your big down, you get your big up, you get your big down, you get your big up, you get your big down, you get your big up. What's going to happen next? Probably a down, right? So that's how you trade. Oh, I'm going to anticipate that this market's going to make an up and down. And then you measure them. This is all you do. You just come in here and say, oh, this market, how far did it go? Oh, it went $2,000 down. And then it went how far up? Oh, $2,000 up. And then it went what? $2,500 down. And then it went $2,200 up. Then it went what? 2,900 down. And then it went what? 2,900 up. Oh my goodness, it's moving in about $3,000 ranges, and it's at the $3,000 range. What's it going to do? Probably going to come down about $2,500, $3,000. So that's probably what it's going to do. Is it for sure going to do that? No, because sometimes it doesn't do that. Look over here. It doesn't always do that. It's just been doing that. So then you're like, well, what's the likelihood it's going to continue to do something like that? A one up for every down. How far is the up going to go? We don't know. We can measure, we can project, we can use Fibonacci numbers, we can do all that. We don't know. All we can do is say, well, the probabilities are that it's going to do this, and then we can put our order in. And then if it doesn't do what we think it's going to do, we get back out. So you get one up, little down, one up, little down, one up, little down, one up, little down, one up, little down. You're in an uptrend. The little downs mean you're in an uptrend, right? The long ups means you're in an uptrend. If you start getting long downs and little ups, then you're in a downtrend. It's that simple. Okay. So we oftentimes make something that's simple complex. So we make it more difficult than it is. Really, all we're trying to do is buy low, sell high, right? So wait for the market to come down. That's what this little indicator here is called the chalk and money flow. All right. And it tells you when big institutions are buying and selling. Big institutions like to buy low. Retail traders, we like to buy high. So generally speaking, the reason they're big institutions and we're little small retailers is because they buy low and sell high, and we buy high and sell low. Usually we do the wrong thing. So we need to start doing what they do, which is buy low and sell high. And so this tool here kind of tells you when these big institutions are buying. So these big institutions are buying here, buying here, buying here. See, green, 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 green means they're buying. Red, 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 red means they're selling, selling, selling. So they're selling here, they're selling here, they're selling here. They're buying here, they're buying here, they're buying here. Does that make sense? Hopefully that's simple enough. So in this case, they bought a whole bunch right here. This is called the accumulation stage, and we've talked about this in the past. But you can see this is where the big banks, the hedge funds, big traders, they're accumulating shares. They're accumulating. They're accumulating. And then what do? They sell them out. Where do they sell them? They sell them as the market's going up. What are we doing? We're buying as the market's going up. They're selling as they're going up because they were buying all down in here. And then they sell, 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 sell. Who are they selling to? Us. We're the ducks. They're feeding the ducks. They're feeding us what they sold us. Okay. We talked about that in the past. You want to learn a little bit more about feeding the ducks? Go back and look in some of our past classes. That's what we're talking about. Now, what I want to do is I want to go, these are just the index funds. Let's go look at some stocks. Do you guys have any favorite stocks? Bruce says he loves my trading style. Mostly I'm just telling silly stories. Hope you guys like silly stories because I just tell silly stories. Just a storyteller. All right. So do you guys have any stocks you want to look at? Anybody have any favorite stocks? While you guys think of your favorite stocks, put them in the little comment section. We'll go look at some individual stocks. Okay. So I'm going to pull this up. One stock I like to look at, or stocks I like to look at, are the FANG. Facebook, Apple, Amazon, Netflix, and Google. We don't call it Facebook anymore. So it's not FANG anymore. It's now MANG. Yes, because it's Meta. So the FANG stocks, okay? So the first one is Apple. So let's look at Apple. Everybody loves Apple, right? We all love Apple. I have an Apple thing. I have an Apple iPhone. So I think that's about the only Apple product I own. But, you know, it's an Apple product. People love Apple. They buy their computers. What else do they have? Anyway, everybody loves Apple. So Apple's really been on a tear here. Really had a nice big run. We generally look for 3 drives, right? We got drive 1 here, and then we got kind of a big pullback. So we start over, but that was kind of a drive there. You could say it kind of went down like that. Now I've got my indicator. This is the bulls and bears indicator, and I've got it reversed. And you'll notice I've reversed it to make it look like the chalk and money flow. Usually that's not how we do it. So we come in here. If we come into the bulls and bears setting, this is my defaults are like this. The TNT defaults are like this. Okay. So you can change these around. So usually, you know, buy low, sell high. When it's down in this region here, it's red because it's going breaking down. And so it's going red. It's in a downtrend. We generally consider downtrends to be bearish. And so we turn the price bars red. Yeah. Right. The yellow price bars, these are neutral zones. Now I make them a little bit more aggressive. I take it off of the traditional and put it on the progressive. And so this is the neutral zone. And that's why it's yellow. All right. So we have green, which is bullish. We have red, which is bearish. And we have yellow, which is neutral. That's the bulls and bears indicators, all based on Fibonacci and Elliott wave. Okay. It's the foundational tools that we use to calculate the waves. Now, what I did is I had this set up like the chalk and money flow, which seems backwards, right? Green is down, red is up. So if we come in here and we change this around, so we go, come down here, and we're going to make this green. We're just going to reverse these and make this one red. Where's red? LMNOPQR. Where's red land? There it is. So now we're kind of like the chalk and money flow, aren't we? We've gone in reverse. So up here, this is all red. So now the bulls and bears, all red. So now if you do that in your mind, green means buy. So now you know when to buy. You start buying when it starts falling, when it gets down here into these bottom regions. This is your buy zones. Okay. These are your buy zones. These are your buy zones down in here. And then once you buy it, you sell it just like the big banks do up in here. This is where you get out. You take your profits. You take your profits. You take your profits. You take your profits. So buy low, sell high. If you want the color codes on the bulls and bears to help you with that, you can make it do that. You can watch the chalk and money flow. This is where you want to buy. You want to be buying when the big banks are buying, when the market pulls back down into here. So there's your buy. And that's Apple. Okay. And then we do our mathematical calculations. So we can look at multiple drives. So we got drive 1, drive 2, drive 3. Once we get to the bottom of drive 3, we generally consider that to be the bottom when we look for a market to turn around and start to rally back up again. So I'm going to anticipate that Apple is not going to do one of these. I think Apple has made its 3-drive pattern down. I think the banks are starting to buy. They've been through an accumulation stage. They got their 3 accumulations. I think we're going to see this thing pull back and have a little profit taking. So we'll get a little pullback in here. But then I think it's going to catch and it's going to go back up and we're going to test this previous high. That's what it should do. Now, is that necessarily what it's going to do? We don't know what it's going to do. Nobody knows. But technically speaking, traditionally speaking, we've looked back at the markets for a lot of times for the last 100 years, and this is what markets have had a tendency to do. So that's why we trade the probabilities, the tendencies of the market. If it doesn't do it, well, we have a backup plan. Plan A, plan B, plan C, right? And that's what we learn in these classes is all of our different plans. What we do are contingencies. Everything we do in trading is an if, then, else. If it does this, then I'll do this, else I'll do this. Just like computer programming. Those of you who have computer programming skills know that markets or computer programming is all about if then else statements. That's all a computer program is. If the user wants to do this, then I'll do this, else I'll do this. If the market does this, then I'll do this, else I'll do this. So that's if the market does this, I'll get in. If it stays in, if it continues to do this, I'll stay in, else I'll get out. That's really what we're doing. If, then, else. All right. So that's how we trade. Everything is a contingency. All right. Bruce says he's got EUC he wants to see. Let's go look at EUC. EUC. I'm not getting an EUC. Oh, UEC. Can't. Dyslexic. UEC. So uranium. Uranium. So an energy stock. All right. So there we go. Energy stock. 3-drive pattern. Drive 1, drive 2, drive 3. Just right straight out of the book. There's your break right there. There's your break right there. Here's your accumulation stage right here. Accumulate, accumulate. Buy, 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 buy. Sell, 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 sell. Buy, 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 buy. Sell, 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 sell. Buy, 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 buy. Sell, 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 sell. Do it 3 times. 1, 2, 3. I want to be a buyer at the top of this one. Probably not, Bruce. Doesn't mean it can't go higher. It certainly can. But we are at the top of a 3rd drive. Can it go into a 4th drive? Certainly. It's only a $5 stock. Go to the moon. Uranium, pretty important type of thing. People kind of want that stuff. So, but we are at the top of a 3rd drive. So you have to take that into consideration. You see this little triangle formation right up here that we created right there. Maybe highlight it a little better. Come in here. Boom, boom, boom. There's your little triangle. It broke out the top of the triangle to give us that 3rd drive. We generally want the 3rd drive to be almost as big as the 1st drive. Okay, so the 1st drive was in here from down here. Let's just say from here to here. $93 for 100 shares. 3rd drive started here. That's $141. So it's actually exceeded the 1st drive. The 2nd drive was $268 for, and the 2nd drive is usually the big one. That's the meat and potatoes. Remember, we always call this, we come in here and we say, this is the hors d'oeuvres. This is the meat and potatoes. This is the dessert. And if we can get any of the dessert and we can catch that, the hors d'oeuvres, we're happy, but we're pigs in shit when we can get that big, huge chunk out of the middle. We love that part. So that's our big trade. And now we're up here kind of fiddling around with this top of this last 3rd drive pattern. The big institutions are up here in the sell zone. They're not buying right now. So the market's in the red zone, coming back into the yellow zone. It's neutral on the Fibonacci scale. So it's made that retracement. We come in here from the low to the high. So you can see right there that the market's come back down into the Fibonacci sweet spot. It's just touching it. So it's just kind of kissing it right there. But that's where it at. Came right back down to that 50% zone, touched it like a train on rails right there, and then bounced and went back up again. So is it going to go up and break all-time new highs and create a 4th drive? It could. But the likelihood is more likely that we're going to bounce around in here a little bit, maybe get a little bit of a retracement, get some accumulation. If these guys really want this stock, they're going to push it down so they can buy low because they don't like to buy high. Banks don't like to buy high. But you never know. This might to them be low. It's only $5 stock. Might be low. Anybody else got a stock they want to talk about? That's a perfect little 3-drive Elliott wave pattern right there. We could Look at Netflix or Meta. Let's look at Meta. Meta never did have that big blow off that the rest of the market had. It stayed strong this whole time. So if we come in and look at this thing from a longer standpoint, you can see the multi-drive pattern in here. It just kept going. It was like the Energizer Bunny. It had drive 1, had that kind of kickback here. It never did go into the green, into the accumulation stage on the bulls and bears, but it did on the chalk and money flow. They started accumulating big time right there. And that's where you see they started to buy in. And then right here, a little bit, little buy-ins here. No buy-ins here, but that was your other break, the bulls and bears. And we ended up with a full, so drive 1, drive 2, drive 3, drive 4. Does it mean it can't go to the 4th drive? No, it certainly can. So there's your 4-drive pattern. And then it comes up here, gave us this little topping pattern, which was the exhaustion pattern up here with a little triangle wedge formation right in there. Popped out the bottom, went back into a reaccumulation stage right in here. So they started buying a little bit right in here once again, pushed it up a little higher, came back, another small accumulation, pushed it up higher. They're trying to accumulate one more time right here, which is a little crazy. So how high is it going to go? If it breaks above this point here, we could see this thing go. We got a couple of really hard, strong areas of resistance. If it closes above that, if it goes up there and stays above there, we'll probably get a test. We'll probably get it to come up, break above. We'll probably get a little pullback, and then we'd expect it to continue and break above and hold above, and away it goes. So that's what we're looking at on Meta. Anybody else got a stock that they're interested in? Most everybody here, I would say, is probably futures traders, aren't we? But we have to do stocks because I teach a stocks class, and people are like, well, hey, Lan, all that future stuff, I'm interested in stocks. So here we go. This is Google. So let's read the Google chart. We come up with this big long run here, and then we got a reset, and then we got 3 drives, drive 1, drive 2, drive 3. But that was kind of, you almost want to call that a 4-drive pattern, right? Even though you got kind of an obvious 3-drive pattern here. We're coming into the ABC pattern right now, so we would anticipate that this market, could have another fall right in here. Now, the question is, how far back is it going to come? Is it going to come all the way back and break the previous low? Is it going to come back and toss across there? Is it going to break that previous low? Let's see if I can get the right tool. If it does, we'd look for it to come down and maybe give us another drive down, right? Because this is what we would call this a 3-drive pattern. If we call this a 3-drive pattern and we come in with our probability table, this is going to be an X1, A1, right? So those of you who have my book, X1/A1, and this is just the probabilities. X1, A1 type plan. There we go. So this is an X1, A1, which is what? For those of you who have my book and know the probabilities, what's Lan's book? This is my book. If you go out on Amazon, you can get this book. It's called Stock Market Playbook of Strategies. Just search Lan H. Turner. It'll pop right up. It's like $35 or something. It's 230 pages or something like that of all these different strategies that we talk about in this class. It's the manual to this class. All right. So if you want the manual to the class, go pick it up. There it is. And then this is going to tell you in there the probabilities of what these trades are. So we can come in just for fun real quick before class is about over. So we're running a little bit over time. That's okay. We'll continue to teach here just real quick. We got X1 and we got X2 and we got X3, right? So on your 3-drive pattern, these are your exit points, X1, X2, X3. Now, I'm not going to go through and label every single thing of this entire drive because we got the A drive, the B drive, the C drive, and we go over and we can do all the probabilities going up. But in the interest of time, we're seeing the markets now coming down with this ABC pattern. That becomes an X1, A1, which is a real low probability of success. If you buy there, you got a real high probability that that thing is not going to make money, okay? Now, if you were smart enough to catch it down here on the Fibonacci retracement, and you bought right down here with these big speculators and it starts to go back up, great. You could be profitable. But be careful because this is such a low probability of success. Doesn't mean it can't continue to rally and go back up. It certainly can. Market can do anything it wants. But statistically speaking, this thing will come down and break this low right here. Will it? Nobody knows. But statistically speaking, that's what it'll do. It'll come down and break that low. And then we'll get, what will we get? Then we'll get the next drive, which is the X2S/A1. So I should be more specific on this. This is actually, come over here, it's actually an X1S. Got to get the S in there because that's the short side. These are long, so we don't put L in there for long. We just assume long. So we have to identify the S. S means short, to the short side. So it's an X1S, first exit to the short side. So if you took the short position, you went short here, this would be your exit point, and then you'd look for the next drive down. That would be where you're taking your profits to the short side, right? So that's the idea. So now X1S A1, it's an A1 because it could be the first A1 drive. Don't chase the A1s because they oftentimes fail. So then we would look for, if this thing comes back and doesn't break this low and create an X2S A1, that would be an X2S A1 to the upside. And you could start taking a long position right in here. Let's say it comes back down to 38.2 or only to 23.6 and starts to go back up once again. Well, once it breaks this high right here, we'd no longer be in a downtrend, right? Because we'd now be making higher highs and higher lows and lower highs and lower lows. And then that's where we would look for this market to continue and to go like this. So that would be the reversal, and that would end up being your head and shoulders bottom formation that we talked about yesterday. There would be your head, that would be your neckline, this would be your right shoulder, and then we'd look for the market to continue higher. If it doesn't do that, we have to grab that whole thing and go down one more level, right? We just grab that thing, go down one more level, and do it again. All right. We'll just keep doing this. I know if this is like, oh my gosh, Lan, you're going over my head. Don't worry. Just keep coming and attending class because we'll just keep doing it over and over and over. And before long, you'll be doing it just as easy as I'm doing it. It'll make all kinds of sense because the markets can only do three things. They can go up, they can go down, they can go sideways. That's all they can do. And so all we want to do is count the waves. Markets move in waves, one up for every down. Boom, 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 boom. Okay, guys, that's it. That's the class. That's today. Thanks for coming and hanging out. I hope you learned something. I hope you had fun. We're going to do some more stock trading coming up here soon. So, guys, those of you who like stocks, bring your favorite stocks with you. Oh, Steve's got CCJ. Let's pull that up real quick. CCJ. Just to see what's going on. We'll look at it real quick. Oh, we're breaking a previous high on here, Steve. We're right up there bouncing, aren't we? So if it can hold above there, watch out for that blue light because it's going to want to break and come back and make a little ABC pattern. But the accumulation stage was right here. They're certainly not accumulating right now, so be careful. Don't go buying into stocks that are up here in these high red zones. You want to be buying the stocks when they're down here in these lower zones, okay? This is your buy zone down here, buy zone down here. All right, so there's Camaro Corporation, common stock. So we're up there making a double top right now. Could it go higher? Always. Markets can do anything they want, but for us, that's a low probability position to be buying right now. That would be buying high in an attempt to sell higher, and that's a tough strategy. I like to buy low, sell high. All right, guys, with that, we'll let you go. We'll see you tomorrow. Same bat channel, same bat cave.